follow along with this question, please refer to the Unit 1 study guide. On page 4, under the heading Closing Entries and Worksheets, please read the question outlined in orange. Remember that the acronym REID, R-E-I-D, was used to help us remember the 4 steps in the closing process. All temporary accounts are closed out to zero, and the temporary accounts were revenues, expenses, income summary, and withdrawals or draws by the owner. So those are the 4 types of temporary accounts. Now, in a merchandising company, we've got some revenue accounts that have debit balances. So in these 2 steps, we're going to make a couple of changes. And for the first step, we're going to close all of the temporary accounts with credit balances. And when we close the expenses, we're going to close all of the temporary accounts with debit balances. So when we look at the trial balance for this company, the first journal entry we're going to do is going to take the 2 revenue accounts, interest and sales, close them out to zero. Remember, when we close an account out to zero, we do the opposite of what the balance of the account is. The second step is going to close all of the temporary accounts with debit balances. So that's going to be all the contra revenue accounts and the expense accounts. The third step is to close that income summary account that gets created with the first 2 closing entries. And the last step in the closing process is to close this withdrawal account out to zero. So let's put all of these closing entries in our general journal. When we close a revenue account, remember we look at the account, and this all happens at the end of the fiscal year, October 31st, and we're going to do the opposite of the balance in the account. So if we close the interest revenue account, we're going to debit the account with the exact same amount that's in there as a credit right now. We're going to close the sales account, $424,000, again, debiting that account. Those are all of the revenue accounts, so we're going to transfer those balances, closing those 2 temporary accounts out to zero. We're going to transfer those balances to the income summary account. The income summary has $425,120 transferred into it. Now I'm just going to make a little T account over here for the income summary. When we get to that third step, we know how much is in there. So this transaction gives us $425,120 in that account. The next step is to close all of the expense accounts out to zero, and when we do that, we debit the income summary for the total of all of those expense accounts and contra revenue accounts. So we have sales discounts for $6,500. We've got sales returns and allowances for $28,000. We've got cost of goods sold, $165,200. We've got sales salaries for $58,000. We've got rent expense for $20,000. We've got store supplies for $5,000. We've got advertising expense for $36,000. We've got office salaries for $53,000. We've got office supplies for $1,600, and we've got rent expense for $5,200. When you total all of those expenses up, we get $378,500. Figure out how much is in that income summary account. We have to calculate the balance of the account by subtracting the debits from the credits, and we get a balance in that income summary account of $46,620, which should be the net income for the company for that period of time. In order to close the income summary out to zero, we have to debit that account, and we have to credit capital. Remember, we're transferring that net income to capital. The last journal entry is to close the withdrawal account, where we debit capital for the amount of the withdrawal, $32,000, and we credit the withdrawal account. So that's the last step in the closing process. Please try this question on your own, and then do some more practice with the exercises listed under the text box in Unit 1.